Welcome to the Binary Institute's Introduction to Binary Options Trading course, Lesson 2, Binary Options Trading versus Traditional Retail Trading. Now, nearly everyone today has some sort of exposure to trading. Perhaps you've studied finance or economics in university and have some theoretical knowledge of how the markets work. Maybe you've actually traded traditional stocks or Forex in the past, and you are aware of the different elements that affect the price movements in the market. You might be a person who reads the finance section of the newspaper every day in order to see how the markets are moving and have an understanding of the different social, economic, and political factors that affect the price movement in the market. Whether you follow the markets closely or you've only heard about the markets on the radio on your commute to work, we're going to dive into the specific details that will give you everything that you need to know in order to be a successful binary options trader. So, today's lesson is going to be focused on what are the differences between traditional retail trading and binary options trading. What are binary options, and what are the advantages of binary options trading? So, let's start with the standard retail trading formula. Whether it's stocks trading or Forex trading, the idea is that we will buy an asset at a particular price. Now, once we've bought the asset, we have the right to hold on to it as long as we want to, whether that's 1 hour, 1 day, 1 month, or 1 year. Essentially, we will decide when we sell the asset, and we will then execute the sale of the trade. Now, in traditional trading, we attempt to buy the asset at the lowest price possible, and then we attempt to sell the asset when it reaches the highest price. We watch the markets closely, and once the price is at its highest level, we will then execute our sale order, and the difference between the buying price and the selling price will be our profit. The greater the difference between our buying and selling price means the bigger the profit for us. For example, let's say that we're interested in trading Apple stock. Now, we take a look at the markets and we see that Apple stock is currently trading at $100 a share. Now, we think that Apple stock is only going to increase in value, so we buy a share of Apple stock for $100. Now, we watch the markets over the next month and we wait and see when Apple stock is going to increase in value. Now, we see that it does. We check the value and we see that Apple stock is now trading at $150 a share. Now, we think that Apple will not increase in value anymore in the near future, so we decide to sell our stock, and we've profited $50. Now, in the most basic terms, this is how traditional retail trading works and how traders profit from the price movements in the markets, whether it be Forex, stocks trading, or commodities trading. Now, in the world of binary options, the idea is vastly different. First of all, we're not actually participating in the buying or selling of the actual asset. Instead, we're buying a contract that gives us the right to the asset for a certain amount of time at a specific price. Now, this might sound a bit confusing, but it's actually quite simple. So let's break it down into a few different parts. Most importantly, there are two types of options contracts that we can trade when we're trading binary options. There is a put position, which is decreasing price movement, and a call position, which is increasing price movement. That's why we call it binary options, because there are only two choices. Either the price is going to go up or the price is going to go down from where it is right now. Whenever you buy a contract, you're going to enter the market at a specific price, which we refer to as the strike price, or some people say the strike rate. Now, this is the current price for the asset. And as we are binary options traders, we need to decide whether the price is going to be higher or lower than this price at the end of our trade. Now, let's see how this works exactly. Now, a trader will look at the market and we'll look at the current price of the asset. Now, if a trader expects the price of the asset will rise from its current level over the next period of time, which could be 10 minutes, 20 minutes, a year, whatever it may be. If a trader expects that the price will rise from its current level over the next period of time, he or she would purchase a call contract. At the end of the contract, or at its expiry time, if the price is higher than the strike price, the trader will win his or her trade. If the price does not go higher than that strike price, then the trade will be a loss. Now, it works in the exact same way for a put contract. If the trader believes that the price is going to be lower than its current position at the end of the contract, then he or she will place a put position. The price is lower than the strike rate at the end of the expiry time, the trader will win the trade. If it's not lower than that price, it will be a loss. Simple, right? Now, let's talk about a few of the benefits of binary options trading, and we'll compare them to the traditional trading formula. First of all, in binary options, everything is fixed or set before you even begin to trade. There's a fixed expiry time when your trade will end. There is fixed risk, and there's a fixed return on your investment. But what does that mean, fixed? Well, let's start off by taking a look at the fixed expiry time. Now, before you even enter the market, you must choose a time when your trade is going to end or expire. Now, on most binary options trading platforms, you have several options in regards to the length of the contract. Usually, you will have the options for binary trades, which usually expire every 10 to 15 minutes, or every half hour or hour, depending on what the asset is. You also usually have short-term contracts, which could be anywhere between 30 to 60 seconds, up to maybe 300 seconds. Now, most platforms also offer long-term contracts, which usually expire anywhere from the end of the week, end of the month, and also you have end of year trades. But whenever you are choosing the expiry time, you are choosing a specific date and time when your contract is over, and you choose this before you even open your trading position. Now, once you've opened your binary options positions, you don't have to continue watching the markets to choose when to sell. Your trade's already opened. At the end of your expiry time, the trade will automatically close. This is, of course, different from traditional trading, where once you open a position, you must follow the markets very closely in order to decide when you want to exit your trade or sell. Now, in regard to fixed risk, in binary options, you will never lose more than your initial investment into a trade. If you open a $10 trade, you will never lose more than that $10 should you lose the trade. In Forex, for example, if you open a position or a lot and the market takes an unexpected turn, your account could be locked and you might not be able to trade unless you have placed some stop loss orders. Now, when we speak about a fixed return on your investment, we're talking about the amount of profit you can earn on each trade. Each binary options contract will offer a return based on your investment. Usually, it's anywhere between 60 to 90% of your investment into that trade. Of course, this depends on your platform and the contracts that are being offered. Now, what that means is if you place a trade for $10 on the Euro-US dollar, for example, and it has an 80% return, you will receive a profit of $8 should you win. $8 is 80% of your $10 investment into your trade. Now, not only will you receive that $10 you invested to the trade, but also the $8 profit, which means at the end of your winning trade, your total payout is going to be $18. Now, another important aspect to remember about binary options is that your return on your investment is not dependent on major price movements in the market. Many binary options traders make large profits in low volatility markets because your trade's success depends on your strike price, or the price you enter the market at. If you open a call position, your trade only needs to be 1 pip or 1 point higher than your strike rate in order to win the trade. Now, in trading, we speak in terms of pips. A pip is the smallest unit of price change, and pips are used to measure the difference in the price of an asset. In binary options, it does not matter if you are 100 pips in the correct direction or just 1 pip in the correct direction. As long as you're at least 1 pip in the correct direction, you will win your trade and you will be in the money, as we say on binary options. You will receive the full payout, the full return on your investment with 1 pip. Now, it's also important to mention that if you are 1 pip off of the strike rate in the wrong direction, you will lose your trade and you will be out of the money. Now, in traditional retail trading, it's a bit different. Depending on what you're trading, your profit will be completely dependent on the price movement of the market. If there's very little price movement, it's not worth selling the asset to earn a small profit. Even more, sometimes you will be required to wait several days or weeks to see a substantial price movement that will allow you to see a significant profit. So, let's do a quick review of the differences between binary options and how they're different from other forms of retail trading. In traditional retail trading, you actually buy the asset. You try to buy the asset at the lowest price and then wait until the price reaches the highest level when you will execute your sale. Now, you can hold on to it as long as you want, whether it's 1 week, 1 month, 1 year. Depending on the investment that you're making into the position, you might need to wait until there is a significant price movement before you will be able to make a substantial profit off of the price movement. In binary options, we're trading contracts, puts and call positions. Each contract will expire at a certain time, so contracts could be as short as 30 or 60 seconds, or as long as several years. You will enter the market at a certain price or a certain strike rate, and as long as your trade is 1 point or 1 pip in the correct direction you've traded, you will win your trade. Each contract has a fixed return on your investment, so your profit from your trade will depend on the size of your investment into the trade, rather than the amount of price movement in the market. And these, ladies and gentlemen, are some of the major differences between trading traditional and binary options. In our next lesson, we're going to go over trading times and how to use market analysis. Until next time, have a great day.